Yeah, that's been the real casualty of the morning, and not sure if it's entirely over just yet. We'll keep an eye out on this and try and touch base with the management as well and see if they have something to share with their stakeholders. But with that, let's move to our market master. Ashwini Agarwal, founder and partner at Demeter Advisors, is with us now. Ashwini, good morning. Great to have you on. So we're in an interesting situation here, right? I think it's earnings, earnings, earnings. That's what the market is squarely focused on, because earnings need to deliver. That's the only critique on India right now. Otherwise, the overall macro narrative remains very positive. Now, what do you make of the market's mental construct? And I want to take today's IT numbers as examples. Infosys actually delivered a beat, not sounding too bearish also. The mid-cap IT companies that have been the market's darlings, Persistent and Coforge, both have delivered. They've not missed at all in the first quarter. But the stock reaction is sharply lower. What does this tell us about the way the market's thinking about earnings and IT in particular?
Good morning, Surabhi. Thanks for having me here. So you're dead right. The reaction of the market to earnings is telling us something that the market is tired. I mean, where earnings are being met, stock prices are not moving. And where earnings are disappointing, stock prices are giving up a lot of gains. I mean, in the sense that in some of the disappointments, even in the mid-cap, small-cap space, you find that stocks are down 15%, 20% on disappointing earnings. So, I mean, good earnings are not giving you a reward, and bad earnings are being punished. So that tells us that, the market overall is a little concerned about valuations. So while there is a hope out there that later in the year, demand conditions will improve, and obviously we are seeing some of that in the consumer names as well, there is some fatigue that's beginning to set in. In IT services in particular, which you highlighted just now, I think valuations are quite expensive. I think when we look at a PE ratio, a lot of the PE ratio comes from a terminal growth, which is built in. And I think there's a big question mark on that in terms of IT services. So, I haven't really been a huge votary of IT services for nearly 3 years now, and I still don't think that they're cheap enough for me to buy. And I think the market's also starting to kind of, recognize that there are some issues that need to be addressed, and valuations are not cheap.
So where does one put one's money to work? Ashwini, morning.
Morning. This is a great question. I think, on a bottom-up basis, like, again, if you look at the opening remarks that you guys made on some stocks which are up, I think on a bottom-up basis, there are some opportunities which one continues to find. But otherwise, the markets are expensive. I think, financials look fine. By and large, I don't think you can make a lot of money from here in financials, but I think over the next couple of quarters, you will see some of the stress in microfinance going away. So, that's one hope that might help, stocks, especially in the NBFC area. Banks overall look fine. I think there will be some compression to NIMs, but hopefully growth will pick up. So that looks macro area. Consumers, like I mentioned, there are a lot of reports that rural demand is starting to improve. There again, you have to be choosy because some companies which have a very high penetration already, for example, Colgate, and just to clarify, I don't own the stock. I mean, they will find it difficult to grow. But I think other areas where you have consumers looking forward to more purchases, there you might see some improvement. So I think it's a mixed bag. I think one has to be more bottom up, and overall one has to be cautious. I think the markets had a huge run, and there's a huge wall of paper ahead of us.
Indeed. Hi, Ashwini. Good morning, and good to see you in. What do you make of these stock market players? Some of them had re-rated big time. Exchanges, we'll keep the energy exchange aside for now. But these capital market players, they were going hammer and tongs. Now, volumes are dipping actually. Even yesterday, if I compare it with the previous session, the volumes on the NSE were down by close to 7-8%. And, if at these valuations, maybe participation will start weaning off a little bit. Probably. The longer-term story is very good. But in the near term, do you think they've run their course? Exchanges, brokerages, wealth management companies, or do you find value in some of these?
A great question, Nigel. you have to break it up. Okay, so wealth management, asset management are franchise businesses. So, let's say, I'm not saying it'll happen, but let's say the market falls by 20%. The earnings of these companies will fall by well less than that because they continue to see inflows, which is a construct of how financial savings are being deployed in this country. And that's true for wealth management. It's true for asset management companies. On the other hand, exchanges and brokerages, they're directly linked to volumes in the market. And if volumes in the market were to go down, you will have a sell-off in these names. Exchanges are very expensive. Brokerages are not that expensive, but brokerages is a highly cyclical business. And exchanges are expensive, but at the same time, it's a highly moated business. I mean, you're not going to get a third exchange or a fourth exchange, in the country. So to that extent, my sense is that I think the wealth management have and asset management have the best franchise value, followed by the exchanges. Exchanges probably have the best franchise value, but they're expensive. So I would put exchanges next. And third would be brokerages. So I think valuations are expensive and one has to be careful, but that's how I think about it.
So Ashwini, the question is, when you gave some examples, you said financial services, you said maybe
Yes.
part of consumer. But again, where? Give us some examples. I mean, if not necessarily a stock idea, you can put the caveat there, but where there is at least some semblance of sustainable growth. Because the problem with the market is growth. So when you say, for instance, if you say consumer or FMCG, if not a Colgate, then what? Because even, let's say, within the QSR space, it's been very, very different. Different companies are doing different things. Westlife yesterday was a good number. Sapphire was weak. So where do you see some semblance of growth within financial services as well? Tier 2 financials showed up various asset quality and credit costs issues. Large banks relatively outperformed. So just slightly more granular on where to put the money in this tough market.
Okay, let me try. Okay, and I don't want to cross any lines here. So in the financial space, in NBFCs, while you're right that the June quarter numbers were not that exciting and credit costs continue to be a bugbear, but I think incrementally the direction of credit losses or incremental stress is coming down. So what you're seeing flowing through the P&L is mostly what has already happened. Now, come December quarter, which is 6 months away, you will start to see a very favorable base effect kick in, and the fact that your incremental NPL generation is coming down, you'll start to see a much better sort of credit cost line for a lot of the NBFCs, especially in the microfinance area. Now, you have to look past the next couple of quarters. That much we have to do. Otherwise, it's very difficult to kind of invest. I mean, you can't invest based on every quarter. So I think that's one area in the NBFC space, in the microfinance space. I think banks are fine. Banks are doing well. There is no major issue, in the banks, and they're not terribly expensive relative to the rest of the market. They're not terribly expensive. So even the frontline banks are not expensive, despite the kind of stellar returns that you've seen in some of the frontline names like ICICI Bank, for example. Now, coming to consumers, I think there one has to be a little more selective. So there are products that people want to consume. So if you look at the consumer today is looking to upgrade his choice of lifestyle. So whether it is cosmetics, whether it is fast food, whether it's instant delivery, whether it's white goods. So there you have to look at, on a very bottom-up basis, where do you think surprise is likely, and where do you think valuations are have some room for improvement. It's a very bottom-up market in that space, but and I agree with you. So, for example, in the QSR space, there are some that have done very well and some that are struggling. So that's the bottom-up work that one needs to do. But that's an area where I see at least the consumers, putting more money to work.
Okay. Bottom up, it's a hard work market. It's not an easy market. That's the takeaway from the conversation. Ashwini, got it. Thank you so much for joining in. That's helpful perspective. Good to have you on. By the way, guys, I just want to mention that